So welcome to this segment of Trading Price Action and how we trade smash bars profitably and effortlessly. In a minute we'll cover what smash bars are, why we use them, and more crucially, when do we use them. But firstly, I just want to tell you that smash bars are pretty counterintuitive. However, they are a very powerful way of anticipating key reversals at price extremities. So for that reason, they're very well suited for range-bound markets at multi-year highs or hard levels of support and resistance. And they essentially give us a very safe entry as well before the actual trade goes into motion. So crucially, what are smash bars? Well, they're a sign of market exhaustion at price extremities. We trade them as in manage and exit them or target them exactly the same way as we do the conventional pin bar strategy. But before we talk about the manage bar, I just want to show you how we can identify them from the get-go. A bearish pin bar reversal is essentially a low test bar or bullish pin bar reversal closing into a level of resistance. So traditionally we would see, if we're trading pin bar reversals, we would wait and anticipate a bearish pin bar reversal or a high test bar at a level of resistance. However, if we're looking at smash bars, then a bearish smash bar is essentially a bullish pin bar reversal where we've got the close at an independent price just closing into a preferably a hard level of resistance. And this is where we look to go short by trading the break of the low with our stop loss above the high in advance of market continuing, well, reversing to the downside here. Okay, and on the flip side, if we're looking for a bullish smash bar reversal, what we will typically anticipate as a reversal point for a long, i.e. it's a level of support, instead of a low test bar or a bullish pin bar reversal, we essentially get a bearish pin bar reversal. It doesn't matter about the color in both instances, by the way, at all. The fact of the matter is it's the profile of the bar which means absolutely everything in this instance. So we want a bearish pin bar reversal, also known as a high test bar, closing into a level of support, and we enter our orders up exactly the same way as we would if it's a conventional pin bar reversal. We just place our order at the break of the high here with our stop loss below the low. The reason why these are so powerful is because our entry here, if we're looking to go long off the back of this bullish smash bar, is because as it's high tested, it's a sign that the market has actually rejected this price point here and it has whiplashed back down again to close as a bearish pin bar reversal. So if we had our entry for a long here, with our entry just above the high of the bar plus spread plus a pip, with our stop loss just below the low minus spread minus a pip, we can reasonably say to ourselves that we're only triggered into the trade, i.e. our entry order is triggered if the bears which initially caused this bar here to high test are no longer there to defend the level. So we're only actually triggered into the trade if it has been confirmed that the bears are no longer there. By the same token, if we're looking at trading a bearish smash bar, i.e. a bullish pin bar reversal closing into a level of resistance here, then it's the same logic. Traditionally, we would assume, quite rightfully, that okay, it's low tested and has whiplashed upwards to cause this low test slash bullish pin bar reversal, which is a bullish sign. However, as it's in a level of resistance, bashing its head against this brick wall here, there's a 70% more likely chance that it's going to ricochet off this level. And of course we only want to be in the safest trades possible, so if we place our order to go short just below the low of this bullish pin bar reversal, minus spread minus a pip, with our stop loss above the high, plus spread plus a pip, then we know full well that we're only triggered into the trade by a broker if the bulls which initially defended the low of this bar here are proven to be no longer there to defend this level here. So essentially you're only in the trade if the bulls have been proven to have been thwarted by the bears here. And this is a very safe entry for that very reason. So just to recap, I know it's very counterintuitive when you've just been studying pin bar reversals and advanced pin bar reversals. However, they make excellent entries, especially in ranging markets on key levels of support or resistance. So in order for a bearish smash bar, we place an order at the low, minus spread, minus a pip of this bullish pin bar reversal, which is knocking its head against a sign of resistance here. And on the flip side, if we're looking to go long off the back of a bullish smash bar, then we are looking for a bearish pin bar reversal where we place our order above the high of the bar plus spread plus a pip with our stop loss just below the low minus spread minus a pip. And of course, in order to qualify, we want this bearish pin bar reversal to be knocking its head against a level of support, i.e. a buy zone, whereas resistance is a sell zone. So just remember that a bearish smash bar reversal or bearish smash bar is indeed a bullish pin bar, and a bullish smash bar is indeed a bearish pin bar. So there we have it. However, we'll go through a few examples because we're going to appreciate this could be quite counterintuitive from the outset for those people who are new. So we can officially qualify a bearish smash bar as a bullish pin bar or a low test closing into a key level of horizontal resistance. It does not matter about its color, like we just mentioned. However, it does matter about the profile of the bar here. So we can see here with New Zealand yen, we have this historical level of resistance here. At a round number, this correlates with 69 spot 100. And we've got a bullish pin bar reversal here. Sign of exhaustion, it's closed below the level, as you can see. However, it's a bullish pin bar reversal in its nature. So, as we've highlighted it here, what we can do, given that the bounce off a level of resistance is 70% more likely than the breakout, we know that if we're going to trade this short with our entry just below the low minus spread minus a pip with our stop loss above the high plus spread plus a pip, that we're only triggered into the trade if the bulls which initially defended this level here are proven to be no longer there. Okay, so this is a hard level of resistance, and typically we get the best smash bar reversals at hard levels, i.e. price extremities where price action hasn't breached the level of resistance or support in over a year. Okay, so we've noted the irony. A bearish smash bar is actually a bullish pin bar or low test, as we discussed earlier. So it is quite ironic. It's actually turning your conventional understanding of pin bar reversals upside down. But the good news is that we manage them and we target them exactly the same way. So the actual management, 60% of the actual strategy is, you already know it if you've looked at the previous modules in advanced pin bar reversal management and also conventional pin bar reversal management. So it's absolutely crucial that you don't go looking for smash bars or trading smash bars unless it's bashing its head against a level of resistance if we're looking to go short, or level of support if we're looking to go long. Okay, so essentially you can see here that the direction is kind of like determined by whether it's a level of resistance, i.e. looking for a short, or a level of support and we're looking to go long off it. Because as you probably are aware, level of resistance is a level of supply and a level of support is a level of demand, where there's value to buy perceived amongst the buyers. So here, this is what happened to New Zealand yen. We had our order just below the low, minus spread minus a pip, with our stop loss above the high, plus spread plus a pip. We were triggered into this one on day 1, and day 2 we started trailing our stop loss. Day 3, day 4 trailed our stop loss, then got stopped out, but we made about 3% on this one overall, risking 2% for the trade. So you can see that we're actually managing this trade exactly the same way as we would any other kind of pin bar strategy which we teach here at the Lazy Trader. So on day 1 we're triggered into the trade, a sign that the bulls which initially defended this as a low test are no longer there to defend the level, and then we had the continuation on day 2 and day 3 and day 4. However, let's look at a long opportunity here, and this is CAD Swiss, another cross-currency pair. Those of you who've been with us for any time will know that we absolutely love cross-currency pairs. It doesn't matter what countries they represent at all, or what the pairing is. It's all about the chart here. We can see here that we've got a very strong level of support here, and a potential buy zone, given that we've seen price action ricochet of this level in mid-November, come up to this well-defined level of resistance just in advance of parity, and come down to this level of support, and we have a bustle that traditionally defined as a bearish sign. However, we've got this safety net of a buy level here, defined to us as a level of support. So what we do in this instance is we know full well that okay, we only want to be long in this particular instance if the bears which caused this bar to high test or closes the bearish pin bar reversal are proven to no longer be there in the market, and the way of confirming this, of course, as we've already discussed, is by having an order just above the high of this bearish pin bar reversal, plus spread plus a pip, so that we're not faked into the trade, with our stop loss just below the low, minus spread minus a pip. And if we're triggered into the trade within the 24-hour period of this bar closing, then it's been confirmed to us that the bulls have come back into the market, and essentially the bears have been overpowered here. So as hopefully you're beginning to see, it's a very safe entry, and it's an entry typically at a key reversal where we're only triggered into the trade if we've got confirmation of the transfer of power between buyers and sellers. So I've said it before, I'll say it again, just remember that we look to trade bullish smash bar long off a level of support, and a bearish smash bar short off a level of resistance. Because levels of resistance signify levels of supply, i.e. people who are long looking to get out of the market and realize their profits, whereas levels of support are perceived as buy zones, where there's value being perceived amongst the buyers to get into the market at the best possible price, or the best perceived price. So here's what happened in our trade CAD Swiss. We were triggered in within 24 hours, and we had the first buy bar here on day 1, day 2, second buy bar. Then we start trailing our stop loss just below the low of every second buy bar if we're long, like I will discuss in a minute, and then we trailed it for every buy bar essentially, to lock in profit along the way, as well as give our trade enough room to breathe. And you can see here it did prove itself to be a very effective turning point. So they give us a very good confirmation that the tide is turning, especially if we're triggered into the trade. It usually happens at key levels of support and resistance, all-time highs, all-time lows, 5-year highs, 5-year lows, 10-year highs, 10-year lows, or even just a box standard hard level of support or resistance, which is a level of support or resistance which has been formed and not broken over the course of a year. So we look at exactly the same criteria as pin bars in order to validate the trade. However, I will say that this strategy works a lot better when we're looking at range bound markets here. It's not quite so effective in trending markets. The reason why they work better in ranging markets is because, unlike trending markets, we've got the straight up structure of the market here defined by levels of support and resistance, and of course the longer the level has been formed over, the stronger it tends to be. Whereas trend lines in trending markets tend to be a little bit more subjective. At least with horizontal levels, they correspond directly with price, i.e. the levels where the big boys, or the big dogs, are buying and selling at, and the values that they're perceived at being with these people. So we can just simply hop on the back of these big moves. We don't want to create the moves ourselves, of course not. How can we? However, we can speculate based on our rules and look to go where there's probability. Okay, so like I've just mentioned, we manage these smash bars exactly the same way as we do our pin bar reversals. If we're long, we trail for every second buyer bar, and if we're short, for every second seller bar, until we're stopped out essentially, so that we can lock in profit along the way, as well as give our trade enough room to breathe, because there's nothing worse than coming out of a trade early before realizing a profit by managing it too aggressively. So in this instance here, in terms of setting up the order, like I've mentioned in context, what we want to do, if we see a smash bar long defined as a bearish pin bar reversal off a horizontal level of support, we would have our entry just above the high plus spread plus a pip to eliminate a false entry where we get a spike and our broker triggers us in anyway, and our stop loss is of course at the low of the bar minus spread minus 1 pip to of course eliminate the same thing, being stopped out early if the trade does go against us. And on the flip side of the coin, for a smash bar short, of course defined by a bullish pin bar off a level of resistance, we'd have our entry just at the low of the bar minus spread minus a pip, whatever the spread is for your broker, minus a pip, with your stop loss above the high of the bar, plus the spread your broker is quoting you, plus 1 pip. So nice and easy. You've probably seen this before, but in terms of what time you place this trade, we want to place it at 10 PM GMT or very early the next morning. So whatever time zone you're in, please do have an awareness as for when 10 p.m. is Greenwich Mean Time, and place your orders accordingly. So the good news is if you're in Asia or Australasia, that will correlate very nicely with your morning time, so you won't have to worry about going out drinking and having to circumvent the prospect of placing those orders up when inebriated, like we do in Europe. Morning your time is absolutely fine. However, if you do want to go out and have fun and indulge in the frivolities of the bars and the pubs and the clubs, then there's absolutely no shame if you did decide this early morning GMT as well, because quite frankly the markets seldomly move overnight unless it's a Sunday night. They're generally asleep until Europe and America opens. So, just to depict visually the management of these smash bars, if you're long and we're going to trade off the back of a bearish pin bar reversal off a level of support, we're triggered into the trade, we trail just below of every second buyer bar minus spread minus a pip. So we trail just here, just below the low of the second buyer bar minus spread minus a pip, and we have a seller bar here, doesn't matter. Then we have another buyer bar 1, and then buyer bar 2. We trail again, minus spread, minus a pip, until we're actually stopped out. So we trail again for this second buyer bar here. Look at the low of the bar, minus spread, minus a pip, and then we're stopped out at a nice profit. And if we're short again, on the flip side of the coin, we have our entry just below the low of this bullish pin bar reversal, bashing its head against this imaginary level of support. We place our entry just below the low, minus spread, minus a pip, triggered into the trade, and we trail for every second seller bar here. So we place our trailed stop just above the high of this second seller bar, plus spread, plus a pip, and then we've got another seller bar 1, and then seller bar 2 here. So we had 2 buy bars in between, so it doesn't matter. This is still seller bar 1 and this is seller bar 2, even though we've got buy bars in between it. So we trail our stop loss just above the high of this seller bar, plus spread, plus a pip, until we're stopped out. So we carry on doing this for every 2 seller bars. So moving on to selecting your targets, you just want to essentially set your target at a price where you want your broker to automatically exit the trade, supposing it goes in your direction and you're away from the charts. But obviously select your target which is within the realms of possibility and probability. Remember that quite often, especially amongst the newer traders out there, there's always, or quite often, a bit of a gulf between what they want to happen in terms of their trade hitting target and what is likely to happen. So there are 2 types of profile really. You can select a high probability low reward target, bearing in mind there's a trade-off between high probability low reward or low probability high reward. Okay, so if you do take the former option and you want to take the high probability low reward target, then go to the next technical level, and of course refer to the module on trade management. You can expect to have a higher frequency of trades, although smaller wins. You will win most of the time, but you'll have a higher frequency of smaller trades and smaller wins. Okay. However, if you do go for the flip side and go for a low probability high reward and go for an increased target or a big target, you can expect to have a higher frequency of losing trades to winners, but your winning trades will have a far higher percentage gain. So it depends again what happens, what resonates most with your personality, quite frankly. For more information about actually selecting targets in all markets, please do refer to the dedicated module on trade management and targeting, because you'll see that it's universal across the board, regardless of whether you're trading pin bar reversal, advanced pin bar reversals, double inside bars, or indeed smash bars. Once you do identify a smash bar, bearish or bullish, place your orders up at 10 p.m. GMT or the equivalent of overnight GMT if you can't make that time. You set your orders up with your broker and you walk away for 24 hours. If your trade's triggered within 24 hours, fantastic, you just leave the order for another 24 hours and then manage it accordingly. However, if you're not triggered within 24 hours, you just simply delete the orders. And why do you think that is? Well, if you're not triggered within 24 hours, it's a sign that there's no momentum in the direction where you're looking for the trade to go, or where you're speculating the direction of where the trade's going to go. There's no momentum in that direction, so of course you don't want to be in the eye of the storm there. We only want to be in the trades which have a decisive rhyme, momentum and speed behind them. Okay, so 24 hours is a very good milestone. If you're not triggered in 24 hours, just delete the order. No matter how good it looks, walk away from the screen and do something else. Celebrate it as being disciplined in your approach and not waiting or falling in love with a trade which frankly has invalidated itself. But if your trade is triggered, then just simply, if we're long, trade it for every 2 buyer bars, or if we're short, trade it for every 2 seller bars. So in conclusion, smash bars, they're very counterintuitive. However, we just manage them and select targets with them according exactly to the same way as conventional pin bars with their entry management and targeting. It's very straightforward in this respect. However, always please bear in mind that a smash bar which looks like a bullish pin bar reversal is essentially bearish, while a smash bar which looks like a bearish pin bar is actually bullish. So please do remember that. That's so crucial if we're looking at trading things as a smash bar.